This is Mohsin. Welcome to my channel. I'm going to be talking about the world economic affairs that go that that it's worth starting this channel with is the oil prices and Russian-Ukraine conflict and how this going to affect all of us. So today is 26th of August, and I am in London. A nice sunny weather, not so cold. But what we need to think about is what happens when it gets cold. So the world has emerged from COVID. Commodities have rallied strongly. Between the mid 2020 and mid 2022, the Bloomberg Commodity Index more than doubled. That's outperformed equity significantly in fulfilling the traditional role as an inflation hedge. However, this rally ran out of steam in June, even for oil. For nearly 2 years, the oil market was significantly undersupplied. For a while, storage can help meet the deficits, but at some point, supply and demand simply need to come into balance. If that can't happen, find a supply side quick enough. It must happen via demand. So the oil market effectively search for the demand destruction price, the price level where that happens can be hard to estimate. In June, we clearly were there for a brief period. Gasoline reaches $180 per barrel, and diesel even reached $190 per barrel. Those prices are difficult for the global economy to absorb, especially if you take into account the dollar has been strengthening. At the same time, with the world central banks hiking interest rates in an effort to slow down the economy as well, oil demand has started to soften and prices have come down. I've given up some of the recent they've given up the strengths recently, and these trends take time to play out, possibly even over several quarters. As long as fears of a recession prevail, oil prices are likely to stay range-bound. After a recession, there always is recovery. There is still a margin of safety in the system, so that demand starts to improve again. This time next year, we may need to ask the question: what is the demand destruction price once again? Now, one commodity that has defied all gravity is the European natural gas. For much of the last decade, Europe was accustomed to a typical natural gas price of somewhere between $6 to $7 per BMT. Recently, it's reached the eye-watering levels of $85 per million barrel British thermal units, which is called MBTU. You want to Google that? On an energy equivalent basis, that would mean similar to oil trading at an equivalent of $500 per barrel. The reason for this, of course, is the Ukraine conflict. And as this Russian-European conflict unfolds, Russia has steadily supplied less and less gas to Europe. Total volumes have already fallen by about 75%. Furthermore, Gazprom announced that flows through the official Nord Stream 1 line project, the power pipeline, temporarily stopped completely later this month for maintenance one of its turbines. In principle, this will only last 3 days, but the market is clearly starting to fear that there is a harbinger of a much longer lasting shutdown. These exceptional prices are already leading to large declines in demand during COVID. Industrial gas consumption in Europe only fell 2 to 3% last month. Industrial gas use was already down 19% year on year. With these demand declines, Europe can probably manage with a reduced supply, but to keep demand lower for longer, gas prices need to be higher for longer. The markets have clearly noticed that. Gas for delivery by end of 2024 is now trading at close to $50 per British metric tons. That's 10 times equivalent to the price in the United States. The full implications of all of this is for the European economy going forward are yet to come, but we will surely keep you updated. I hope you found this useful, and I'm planning to do this on a weekly basis, try to talk about key areas or economy and interesting themes that are coming out of the global markets. and would love to get your feedback. And don't forget to like and subscribe my page. If